Imagine unlocking a silent vault at 2 a.m. Elon Musk isn't inside, but his favorite resource is time. On the first page sits a ledger with only 3 purchases written in ink. Under them, a simple rule: buy what you can hold for 20 years. Which 3 would earn a permanent place in your family's story? Look at what lasts, not what trends. Over 20 or 30 years, fortunes that endure lean on assets that pay while you sleep and grow while you learn. Ownership beats opinion. One practical rule before we go further: if an asset can't survive a 5-year storm, it doesn't deserve a 20-year hold. If that feels strict, good. Strict keeps you free. This is Wealth Mentor Pro, where every lesson is a step closer to your freedom. Today, we press into a simple, stubborn idea the wealthy actually live by: generational wealth assets. Rich people buy and never sell, inspired by Elon Musk. Stay with me, because the examples are concrete, the transitions are gentle, and the payoffs will feel usable by tonight. Think of money like navigation. Without a compass, even strong engines drift. With one, tiny course changes compound into new coastlines. Here's a bearing you can picture: a 12-unit apartment building in a working neighborhood, each unit at $1,200 a month. After taxes, insurance, repairs, management, and vacancies, the owner clears a steady surplus, then raises rents a measured 2% a year. Roofs age, tenants move. Yet the route remains predictable because people need shelter in every season. Take one step to anchor this idea today. Walk a single city block, 4 corners, 4 addresses, and talk to one property manager about average stay, typical repair cost, and current occupancy. The price of ignoring this is simple and expensive. Your savings drift with headlines while someone else collects your rent every first of the month. But property isn't the only compass. What's the second instrument on the dashboard? Think of a sea lane that cargo ships follow no matter the weather. That's broad ownership of productive businesses through a low-fee index fund. Index fund means a simple basket that tracks a market. No guesswork, no hero trades, just reliable coverage at low cost. Picture an automatic purchase of $300 every Friday into a broad market index for 10 years. Some weeks sting, some months soar. Over 520 deposits, your discipline turns chaos into a quiet engine. Equity means ownership. It's a claim on future cash flows, not a lottery ticket. Start small and keep it mechanical. Automate the smallest weekly amount you won't miss, even $25, inside your retirement account or brokerage. If you skip this, every headline becomes a steering wheel and news cycles start setting your net worth. But there's a third route wealth builders love, and it doesn't require a ticker symbol. Think of a safe harbor you build yourself, with pilings sunk deep and invoices arriving on time. That's a small operating business with repeat customers and boring receipts. Imagine a neighborhood laundry with card readers, or a micro software service that bills $29 a month to 1,000 users. That's $29,000 in monthly revenue before expenses, charged while you sleep at 2 a.m. You don't need a unicorn. You need something useful, repeatable, and dull enough to maintain over years. List one skill you already have. Repair, design, analytics, language, and sketch a $20 monthly service a stranger would gladly pay for 12 months straight. Ignore this, and you keep trading hours for dollars, while owners collect dollars for hours they no longer work. Now here's a question most financial advice dodges. Are you building a portfolio, or are you building a system that makes selling unnecessary? Here's the twist most people miss. When most folks hear risk, they picture price swings. When long-term owners hear risk, they picture fragility. Volatility is price bouncing. Fragility is the engine braking. Different problem, different response. The point of the never sell mindset isn't stubbornness, it's structure. Generational wealth assets. Rich people buy and never sell. Inspired by Elon Musk. That's a design principle. It says build holdings that earn today, strengthen tomorrow, and resist erosion while you sleep. Quick gut check as we pivot. Which asset would you keep through a 10-year storm, and why? Share your answer in the comments. Your thinking helps other viewers think longer and calmer. Rule 1. Own cash flow, rent volatility. Prices will shake. Cash flow keeps your life steady. Cash flow means money left after every real cost. Repairs, vacancies, insurance, taxes, management, and a sleep-at-night reserve. Why it matters is obvious on a kitchen table. Cash pays groceries, rent, or your kids' music lessons, even when the market sulks. Concrete example, if a duplex pays you $900 a month after all expenses, that's $10,800 this year, whether the price chart smiles or frowns. 2 habits make this rule durable. Track income and expenses monthly, not annually, so small leaks don't sink big plans. And keep a buffer equal to 3 months of costs. That cushion turns scary months into boring emails. If price drops 20% this year, but checks still arrive, your life feels fine. If price soars 20% and cash evaporates, your life feels fragile. Aim your eyes at the money moving in, not the motion on a screen. Rule 2. Pre-decide a never sell threshold, then allow rare defined exceptions. A threshold is a line you draw for emotions flood the room. Why it matters. Pre-commitment protects decades of compounding from the moods of a single morning. Example of a clear rule you can copy. You only sell for 1 of 5 structural breaks. Fraud discovered, permanent loss of competitive edge, broken balance sheet, catastrophic regulation, or a radical change in your personal plan. Drawdown is the temporary drop from a prior peak. Treat it as the toll you pay for long-term ownership, not a verdict on your judgment. Make the exceptions real by writing them on paper. When fear shouts after a red candle or a rough headline, ask, which structural break happened? If none, your rule holds. If one did, you act quickly and move capital to safer water. This is how calm beats clever. Rule 3. Reinvest rivers into wider moats. A moat is protection, brand, location, contracts, or network effects that makes your cash hard to compete away. Why it matters. Reinvestment multiplies the engine and moats defend it while you sleep. Concrete example, from the $10,800 a year in duplex cash flow, earmark $5,400 for growth. Acquire 1 more unit. Fund an upgrade that raises pricing power by 3 to 5%, or stack reserves until you hold 6 months of operating costs. 3 simple practices pull this from theory into habit. Put a quarterly date on your calendar and allocate before lifestyle expands. Measure 1 moat metric that fits your asset: occupancy rate, average contract length, or monthly churn. Improving that single number each quarter deepens the ditch. And treat windfalls as fuel, not fireworks. A $3,000 tax refund can vanish in a weekend, converted into a feature, a unit, or a month of safety, and it compounds for years. You might wonder whether selling is ever smart. Yes, when a structural break hits, you exit and redeploy. When an asset becomes more work than return, you upgrade. The point isn't to hold forever, no matter what. The point is to hold until the thesis breaks, not until your nerves do. Compounding likes time, patience, and boring calendars. Interrupt it less and it pays you more. Let's bring the ledger back into view. Those 3 inked purchases share 3 traits that make them keepers. They throw off cash today, they have real levers for growth tomorrow, and they come with moats that survive rough weather. In practice, line 1 often reads essential shelter, like apartments, workforce housing, or storage with stable local demand. Line 2 is operating business with recurring revenue, where recurring simply means the same customer pays again next month. A service with churn under 4% monthly becomes a dependable river. Line 3 is broad ownership of productive companies, often via low turnover index funds. Less than 10% annual turnover keeps taxes and errors quiet. If you wrote those 3 lines for your family today, what could you realistically acquire in the next 90 days? Numbers help you feel progress instead of just hope for it. If you own nothing right now, set a first target of $100 a month in pure cash flow within 120 days. That could be a tiny subscription, 2 storage lockers sublet correctly, or a weekend microservice. Next target, $500 a month within a year. At $500, one household bill disappears. At $2,000, a part-time job becomes optional. At $5,000, time changes shape. Set checkpoints in dollars and dates so you can point to a page, not just a feeling. Now let's make it practical with one simple equation you can carry in your head. Wealth equals ownership times time times cash flow minus distraction. Write it like this in your notes tonight. W equals O times T times C minus D. Ownership is your percentage. Time is how many years you actually hold. Cash flow is what lands after real costs. Distraction is anything that forces a sale without a structural reason. Lower D and the other 3 expand without extra drama. Success starts looking less like adrenaline and more like a boring checklist finished at 9 a.m. on Tuesdays. Back to that 2 a.m. vault. The concrete is cold and the ink doesn't smudge. You don't need to be a billionaire to write on that page. You need a compass you trust, a sea lane you won't abandon in storms, and a harbor that pays at 2 a.m. while your phone is off. Pick one bearing tonight. Choose one lane to automate this week. Build one pier this quarter. The map gets clearer with every mile you travel. Subscribe for more like this and watch the video we've lined up next.